Hello guys, welcome back to the channel. So in this new video I want to share with you the second model B, that you can utilize alongside model A. But before I start the video, I want to remind you that I'm not a financial advisor. Please do not use anything you hear from my videos as an sort of financial advice. And before I review model B, I want to clarify a few things pertaining to model A, because I've noticed that a number of you guys have not fully understood how to execute model A, because some of you have been sending me your results and some of you have been funded through that model, and I'm really excited about it. However, it's not just about having a winning trade. When you send me your work, you've had a winning trade that was executed incorrectly, I will tell you right away that this is incorrect. And that's why maybe some of you have been, you know, um, disappointed that when you send me your work, I tell you this is not right, even if the trade was a winning trade. But hey, I want you to pay much attention to what I'm going to explain here, because this is obviously maybe the last time that I'm going to touch on model A. There are two ways that you trade model A, which I explained in my previous videos, but I'm going to clarify them in a more simpler way that I can. So pay much attention. Now, model A is based off trading sessions. You basically compare the price action of the previous session with the current session. So you wake up in the morning and London opens. Now you look what London does, behaves against the previous session. So if we have a low and a high of the previous session, and then London takes out the high, we anticipate price grabbing liquidity, and then it's gonna reverse to replies to maybe the next pool of liquidity or to an imbalance. All right, whichever it is, we anticipate a pullback in price. Okay, so now one thing that I noticed that guys didn't understand is that model A can be used on any time frame and on any instrument. Just because I gave examples on the DAX doesn't mean it only works on the DAX. You can use it on the pairs, commodities, indices, futures. It's the same thing. Compare, have your indicator for the sessions, wait for the current session that has opened, and see what it does to the previous session. All right. So it takes out the high of the previous session. You wait for a reversal, but I'm going to give you examples. So take, for instance, London. This is London opens here, and this is Asian high, Asian low, and we have these kind of highs, and we see London has taken the high of Asian session high. All right, now the what you wait for is that price needs to take out this previous low. Why? Because in the order of institutional order flow, when price puts in a swing high after a low, that law has to be respected if it is a valid law. In any case that law is violated and breached, it means we have a new state of price delivery as bearish. The same thing applies in the bullish manner. Now, when this law, when price comes back and takes out this low, we anticipate bearish move incoming. So you mark from this swing low to the high. By the way, this can happen. You can watch your grabs of liquidity happening on M15, M5, but you take your trades on M2, M1, I think preferably M1 and M2. But the moment the previous day's high or low is taken, you can wait for the same reversal signatures, preferably on M5. All right. But session highs and lows, like Asian session high low, London session high low, New York high low, you can go M2, M2, M1. Now what we need is a 50% of this move, which is gonna be right here. That's a 50%. So now we wait a mitigation to come into 50%. Entry over there, your stop loss is going to be here. This is the first way, first method of trading model A. Okay. Now, there are situations where, that we will illustrate, price comes back down, it fails to take this low, instead, just done. Yeah, there are situations price fails to take this low, instead price breaks the high. Now when this happens, we conclude that price is bullish, so we're not going to be fighting the trend. What we do when this happens is that you're going to put your fib back here from the high to the low. This is a 50%. So when price comes into the 50%, you take a long trade. Okay, but it starts, show you, it starts by price rejecting this low. It takes liquidity, we anticipate the previous low to be taken, price rejects the low, puts in a new high. So now we change our bias from bearish to bullish, and now a 50% of this move in here, price comes into it, and then we buy. Now somebody says, hey brother, what if price, we anticipate to buy here, but price just decides to take out all these lows? Well, you are 1% down, negative. Okay, there is no way you can avoid taking a loss in this industry. It's impossible. Now you are 1% down. Now you know that, okay, so that this swing that was taken, it means that price was still accumulating short orders. Okay, so the fact that you've taken a loss here, it doesn't mean that the strategy has failed. No, you followed the rules. Now what you do is take the fibs again from this low to the high and wait for price to come back in here and sell. And when you sell, you recover your 1%, your loss, and then with some profit. So this is the second way to trade that model. All right. So you can Watch this part again and again and again, multiple times, until you fully understand how this model works. Because I don't want to be receiving messages, hey brother, I'm 2% up on my on my challenge, and then when I see the trades you are taking are not in line with what I'm teaching, even though the trade was a win. Anybody can literally open the chart, go buy, sell, and then have a win. But can you do that? No. Consistently in the long run? No. All right. So I want you to watch this part again until you fully understand um, how this stuff works. All right. So now I want to introduce Model B. Now this Model A is a reversal, but Model B is a continuation. So you have price taking this, you have price taking this liquidity, all right? This we reverse, put in another low. The reversal happened here. Now the Model B is, you need a lot of patience. It is a high win rate model. Let me repeat that. Model B is a very high win rate model, but you need patience. If you're going to be trading for 2 hours a day, you need patience to sit, get a cup of coffee or tea, sit and wait for the model to present itself. It is a very high win rate model. Now, with Model B, what you need is a grab of liquidity, an order block, or a propulsion block. I'm gonna write those down. One, liquidity runs. Oops. 2, order block. 3, propulsion block. These 3. This is what you need. Now, the first thing is to identify. Please, I want you to fully understand what I'm saying. Do not listen to this in a haste or skipping some parts. Listen to me. The first thing is to identify if price has taken liquidity. We have a reversal. We are not trading the reversal. Be patient. You have the higher time frame key level pool of liquidity that price is being drawn to. Now, the second thing you're going to be waiting for is the creation of the order block. How is the order block created? And what is an order block, by the way? An order block is the candlestick that is responsible in the stop runs. The candlestick or candlesticks that is responsible in running on stops, or what is the proper English? The candlestick that is responsible in the grab of liquidity. For instance, this candlestick here is an order block. This candlestick here, even though price went lower to grab more liquidity, is an order block. An order block is not the last candlestick before price break structure. Guys, go to YouTube, go to the channel of the ICT. Watch him explain an order block. An order block is not the last candlestick before the up move or the last candlestick before the down move. That's not an order block. An order block is the candle or candles that were used to run on stops. Okay? So now we wait for that to happen. By the way, this grab of liquidity on the higher time frame key could be H1, M15, M30, let's say H1, M15. Now we have a reversal on M1 because remember when there's a grab of liquidity in most cases, if it's H1, M30, M15, the reversal is going to happen on M15. And on M1, I'm sorry. And then what you're going to see on the higher time frame, it will be just a rejection candle. Now, let's continue. Now, what you are waiting for, pay attention. This is model B now. Is price continue up and then suddenly price comes back. Remember, you are not trading this mitigation block. Price goes lower. It goes below this swing low by, I'm going to write it. Oh, no, I can include it here. Order block stroke one candlestick. So price goes below this swing low. We need to see one candlestick, either one candlestick close below or a candlestick actually going below this swing low and then reject to go up. I'll show you examples shortly. To reject. So if you see multiple candlesticks closing below, it is invalid. What you need is one candlestick to close below, and then the next candle overshadows the previous candle, an engulfing candlestick. I'll show you example shortly. Now, when that happens, you need a candle that breaks the previous candlestick in here with the wick below. The third candle is the one you take price to go up. I'm sorry. Let me show you example. I have something here. All right. This is what I have. Pay attention. We have price is bullish. You see, highs, lows, highs, lows. We have the target. This is the target here. The next pool of liquidity. Now, as you are waiting patient, this is what happens. Price makes swing high, low, a high, and suddenly we have a candle that goes below this swing low. It might close below. If it closes below, oh God, like that, like that. If it closes below, remember, this is hard time frame key level. Let's say because you are using intraday charts, so let's say H1 or M15 swing high, M15 swing low. That swing low, maybe it's down here. It has already been taken. So in this situation, we have a continuation print. Okay, so a run on stops. The only way we know it's a run on stops is that price has already grabbed the liquidity below here, and now we are targeting the next liquidity. Now the other scenario we need is another, price taking more liquidity, internal liquidity in here, and we need one candlestick. Please pay attention. We need one candlestick only. If price was going to print multiple candlesticks, it is invalidated. Key level here that was taken, the next key level on M15 or H1. Now this is happening on M1. Once you highlight your key levels, okay, you switch to M1 or M2. If your key level is maybe H4, then you would base switch on M5. So the higher in time frame your key levels are, the higher in time frame you're going to be. Let's say if this was your key levels were on the D1, the daily, definitely you're going to be looking for these scenarios at least on H1 or H4. But if your key levels are H1 or M15 or M30, drop to M1 or M2 and be patient. Look for this to happen. The grab of liquidity, the creation of the order block is going to be one candlestick only. And immediately we have a bullish candle that takes out the high of that order block. And this candle must have a wick below that is lower than this candle, with like this illustration right here. In any case, you have a candle without a wick, it's invalid because we have equal laws. Listen to me, invalidated. But if you see a wick that has taken the previous candle and this candle has taken the high, the third candle, you're gonna wait for a retest in this order block. This is the valid order block. This candle here, you enter here and the first target would be this high and eventually the highest high. Now, that was for the order. What about the proportion block? This is when the proportion block is a candlestick. You see, we have an order block. Let's say the next candle doesn't take this high. This. Like this. What do? You wait for another candle that is going to open here to continue until this high is taken. And then you're going to wait for the retest. Now, a proportional block, when this candle has taken this liquidity and the next candle opens, the other candle, bearish candle that is in the range of this order block is a proportional block. So if I were to turn this into a bearish candle like that, and I'll make it like, so I'll show you. Opened, and it's something like this. I don't know how to perfect this, guys. Let's say we have this candle closed here, the other one closed here, opened here, I'm sorry, takes the low of this candle, but it's still a bearish candle that fails to close below this candle, but also fails to go above this candle. We anticipate, in most cases, that when finally price has taken this high, we anticipate that the next candle that opens here will come lower first to touch with this proportion block. So that means the power of this order block has been passed onto this other candle. So it will take its responsibilities of driving the market higher. I'll show you examples. All right, so I'm going to get rid of these so that I can show you examples. And now, because I've been showing you examples on the DAX, let me use currencies now. Okay, so M15. I'll put my indicator for the sessions. Here is Asia, London, and New York session. Now, on this candle right here is London session that just opened. And then my eyes takes me to two things. First thing is, I ask myself, where is the next draw on liquidity, either buy side or sell side? On the buy side, I see this swing high. So the closest swing highs below and above are your draw on liquidity. The next swing high that's closer will be this one. This candle is London. But then I notice that this candle has fulfilled our criteria. We have a candle that takes a low and we don't have a continuation to the downside. It actually closed in the same range. Now, is that a random stops? Yes, according to the criteria I showed you. Now, where is the next draw on liquidity? It will be this high. Am I trading the reversal in this model? No. This is M15, so what do I do next? Switch to M1. Okay. M1. We have a reversal here, but we are not trading the reversal. We are patient, waiting. Now, let's say, for instance, we price. Let me do this. Let's say price was here and we have this drawn liquidity after price has taken liquidity. Remember, price moves from liquid to liquidity. So if we have sell stops taken, the next is price seeking, or the algorithm seeking the next pool of liquidity, which would be this high. Now, so the first phase has been completed, which is we understand that now price is bullish because we've run on the sell stops. Phase one is done. If price, you see this microstructure here, if price had done something like this, let me show you. You see this low, please pay attention. A low, can you see that? If price had gone lower, bearish candle, I'm gonna add, all right, and the next candle opens here, right, takes the high with a wick, and it's a bullish candle. This, ladies and gentlemen, is what I would have been looking for. You are patiently looking for this to happen. Let me count. Phase 1, price is bullish. Why? We have already learned on stops and we have a reversal. Now I'm waiting for a continuation to learn into these buy stops. If there is a candle that goes below this swing low, either rejects or closes below, it's okay, it's the same thing. What I don't want to see is multiple candlesticks printing to the downside. We need one candlestick to either reject with a wick or close below, but the second candle has to close above it. It has to overshadow it. It has to be an engulfing candle with a wick below the previous candle. Now, the third candle that opens here, it's gonna push back, a pullback. It will have a pullback and it's gonna leave a wick. Why a wick? Because it's gonna reject this order block. And this is the one we buy. This is the true order block. A run-on stops. Smart money buys it, engulfs it. The next candle that should have opened here comes back to retest the order block. Boom. Our buy here. Stop below the order block. 1 to 2 into this structure. It's not 1 to 2, so we push it a little bit higher until we have 1 to 2 and there. This is what I should have done, but if I just hold on guys. So I'm going to remove the replay. So this low was respected. Okay, we are waiting. Price takes that high. Now I'm waiting to see. This is what I was telling you. Price takes a low, but we have multiple candlesticks. I would have loved to see this candle closing below. The next candle overtakes it. Okay, but I know on the higher time frame, let's see, that could have been all right. Wait, I am so excited. There you go, M5, run the stops. But this, I don't like it because this candle, it should have taken out the high. But remember, sometimes it doesn't. If it has taken the high, that is 100% confirmation for me. This I would call it like a 75% confirmation, which is less has less probability compared to the one that would have overshadowed this candle. So run-on stops. It took two candlesticks to break the high, which is not what I would have loved, but it's okay. Then price, this candlestick, I want you to watch, came back into it. Now the question is, bro, the high has been taken. Isn't price supposed to reverse? We don't know that. We don't know that. Because if price is bullish, it will be going through all these PDRs like they are nothing. Same thing when price is bearish. That's why you need to read market structure, the candlesticks. Now a run stops with one candlestick, a pullback closes above it. Look at this candle. These are the true order blocks, guys, not what you are saying. Anyways, that's none of my business. Price comes back. Where do we touch? The order block. Buy. Now here, since price is bullish and we don't have the next drawn liquidity would be this high, but it just taken it with one candlestick. So you will base this trade on the RR, risk to reward ratio, which would be 1 to 2 in here, and you're done. If you want to have more than 1 to 2, you can look for structures H1 and above. All right. The second scenario. Now, this is not qualified because price is bullish. In a bullish, we use run on sell stops. In a bearish price action, we look for run on buy stops. Now we see price putting in a low here. Boom. This is what I was telling you about propulsion blocks, because this is an order block. This is an order block, but we have other candlesticks, bearish candlesticks within the range of this order block. So price can either come and touch this order block, or price can just come and touch the propulsion blocks. We have a run on stops because we put in a swing low, price takes it with this candlestick. We don't have a continuation to the downside. Price takes the high of the order block. If you want, you would have taken this trade. You see, no reversal, only continuations. Below here, there is your 1:2. You would have taken even up to 3. And we had news. No, I think this was NFP. I think this should have been NFP. Look at this. NFP opened here. Boom, went down to where? To the propulsion block. These propulsion blocks, we didn't go through it. Can you see how powerful a true valid order block, propulsion blocks are? Not when you go in here and people start telling you this is an order block. Who told you this is an order block? These are called mitigation blocks. When you go on M1, it's gonna look like this. You understand? These are propulsion mitigation blocks, not order blocks, and they carry different functions. So now I'll switch to M1 again. Ooh, this is really good. Same example. So you've had, look how much patience you need. From here, when London opened, you have patience. You are still waiting. Some of you are like, maybe it's over. Maybe it's over. Now you have one trade, and that's not all. On M1 for continuations, where are we running on stops? A swing high, a low, price takes it here. Which candlestick was used to take it? This stops. This one, which rejected. Did we close the previous candle? No, so it's invalidated, so price goes lower. Which other candlestick was used? This one right here. This candlestick right here. What are these other candlesticks that are in the range of the order block? Propulsion blocks. And that's why when this price came here, where did we touch? the proportion blocks, ladies and gentlemen. This candle tapped into the order block. Notice how price didn't come to the proportion blocks until oh god, this is nice. So in there, below, and boom. How many trades in one session? I'm not saying you should be taking multiple trades, but you can if you want to, because if you're looking for key levels on M15 H1 and you switch to M1 and M2, you're definitely gonna find multiple trades in a day. But don't do it. Don't do it. Now, price takes a high. Are we trading this one? No. Why? Because we are in bullish price action until the next low, the previous low, has been violated. Ladies and gentlemen, what happens when we have this, occurrence, this thing happening here? A reversal. So how do you do it? Fib from this low all the way to the high. Where is your 50%? There it is. Your entry will be here. Stop loss, remember, at the high. How much pips are you risking? 14 pips. And your 1:2. But this right here is not model B. What I've been explaining right here is model B. This would be the reversal, which is model A. If you wanted a model B in here, after the reversal has happened, the reversal happens here, you wait for the mitigation, price goes down, the mitigation happens here, price, we don't see, we have multiple, I'm sorry, hold on guys, give me a second, I have to double check this. Yeah, so we have one random stops, price, one candle, price drops. Remember, one candle breaks it, comes back into it. This is your trade, sell. Remember, you're not trading the reversal. The reversal was traded here. You're just waiting for continuations now to the downside since price has reversed. Your stop loss, somebody's going to put the stop loss here. Like 2 pips. What are you doing? It has to be at least, I think 10 pips is really good. Like there or here, actually, 10 pips. Yeah, 11 pips, that's okay. And 1 to 2, there it is. And since we are in the down price section, here is another model B. Yes, a low, a high, a run on stops by one candlestick, boom, back into there. But this is not perfect. Why? Because we need one candlestick to break this order block, not multiple. Let's switch to M2 and see how what it looks like. There you go. This is what, oh God, I feel so nice. You see, one candle up, one candle down, but here's the problem. I wanted this wick to take out the previous candle like that. So this is not 100% confirmation. This is at least a 75% confirmation. So if you were risking like 2% on your challenge, on your account, whichever it is, now you reduce it a little bit. So price comes back in there. Now you sell until price closes. Now, but let's look for another example. I'll put back my indicator. So since I've shown you examples from here, I'm going to remove Friday and check from here. Okay. Now, this is Thursday. You just woken up. You just woke up and London opens. Boom. Right here. You see? London opens. And then you ask yourself, what am I looking at? You realize that Asia had a run on stops. You see this law or this one? Let's use this one. Boom. A candlestick, a 75% confirmation. Why? Because I wanted one candle to take the high of this order block. Let's see if we switch to M30, what happens. You see, that's not what I'm looking for, but H1 does it better because we go through it, reject, and then the next candle takes out the high. So this is a good one. But on M15, it's a 75. So London opens and then drops. In the process of dropping, we create another order block. But before I go there, I actually forgot to mark my key levels. Where is the next high or low that you are seeing? One. What about the low? The low would be this one. But this, in the process of creating this low, we also grab the liquidity, which means I believe this is like these are thoughts that are going through your mind when you're looking on the charts in the morning. Since this candle has run stops, I think it's gonna hold price to come and attack this buy side. So now price creates another order block that runs into this low, and in that process, look, boom, touches that candlestick, and then price goes up. Now for model B, are we trading this? No. This is M15. We look for continuations into here. So M1, hope you're paying attention. We have a reversal. That's okay, we don't care about that one. And here we go. We create from the low to the high, a low. These are liquidity traps. Do you remember the two Zoom calls I had? I shared them on my YouTube. What I was explaining, when price is creating higher highs, lower lows, these swings, and then we have these minor ones. These are traps. So price runs on that stops and then continues going up. Now, when this happens, this is where most people are going to be trading mitigation blocks at 50%, or we are selling. Why would you be selling? Anyways, let me continue. So a run on stops. I want you to take note of this candle, okay, that takes the low. What is the next thing we want when this low has been taken? Price to take this bearish candle. It doesn't happen. Now this candle goes through. Then we have this candle that tries to push up, fails. We create one order block. Two, what is this? A propulsion block. A propulsion block is a candlestick that is in the range of an order block, even though it seems to have pushed below that order block, but it is still a valid propulsion block. So price breaks the high of the propulsion block, we come back into it to retest it. Boom. How many candlesticks? One candlestick. Did we see continuation to the downside? Slightly, yes, by this candle. So this is not 100% confirmation, but we break it to the upside. You enter here and your next target will be this. Your next target will be this. Your 1 to 2. You actually had 1 to 4, but your 1 to 2 is enough. We still have this up here. But remember, you've been all patient right here. Then first step is to see a reversal by grabbing liquidity. You don't trade it. Patience. You trade the what do you call it? Intra price action, what is that? But anyways, you go inside the chart, inside the candlesticks on the lower time frame. Look for reaccumulations. I know we are used after a reversal that a reaccumulation will be something like this, that this is the first reaccumulation. This is the perfect one. Entry, stop loss here. This law is going to be protected. That's the first trade. Where do you see the next trade? Remember, we are bullish, so anything that is happening to sell, you ignore. We already know price is bullish because the higher time frame key level was taken. We had a reversal, so I'm inside here targeting this high. So this low gets violated by how many candles, ladies and gentlemen? One candlestick. A 75%. Why? Because I wanted the next candle to take out the high. Price comes back to the candlestick, but if we switch to M2, we are likely to see our 100% confirmation, and there it is. So in most cases, when you see a 75% confirmation, you can switch to the next higher time frame. If it's M1, switch to M2, you are likely to find 100% confirmation. If it's not, switch to M3, M4, M5, and see at least if your key level is H1 and below, your entry shouldn't go beyond M5. If your key levels are higher than H1, then your entries should be at least M15, M30, H1. Okay. Even M5 is okay. So now you have another entry here. Below and 1:8. But of course, you just need 1:2. Some of you can go for 1:3. 1:3. It's up to you. Okay. So this is how you trade Model B. This is a very high win rate. So I don't know how to explain this to you guys, but if you are so patient, I don't want you to chase price. I told you it's one candlestick. If I don't want to see people asking me, when you see something like this price, it keeps going lower, and then you keep chasing it. If we have this happening, Mm? If we see this happening, if this had happened, and we see the next bullish candle taking out with a wick, huh? Ladies and gentlemen, this is not valid. I don't care if it has engulfed the previous candle. It's not valid. Why? Because it's not one candlestick. We need one candlestick. Ooh. All right. Should I check on DAX? I think this video has been longer already, and okay, even on the higher time frame, guys, this is H1. Seriously, look, boom, down stops. How many candlesticks? One candlestick. This is a 75 because this bullish candle doesn't have a wick below here, which is still valid, but a 75. And where did the third candle come to, ladies and gentlemen? Boom, to that candle, and look what happened. Where, since this is H1, where is the next pool of liquidity? Here, first target, and finally, last target. And look, price has been bullish ever since. What else do you want me to share with you guys? What else do you want me to say? Huh? Look. One candlestick breaks through. This is still H1. The other candlesticks have been in the range of that order block. When price broke above this, actually this was like a reversal to me. That's why it seems like. Why? Because a reversal is gonna do this. It will break the previous structure. A continuation is just a break of the order block, which happened where? Here. This candlestick broke the high of the order block, came back to the proportional block, entry protection here, and you can see, and this also is a proportional block. Why? Because it is inside the range of the order block. See that? So this candle comes back to the proportional block, and look, massive move. DAX, I don't even have to go further. I just opened DAX and I've just seen the model. Boom, one candlestick, a proportion block there. Huh? A line on stops. Price fails to give us 100%, but we create a proportion block that is in the range of this order block. Finally, we break the proportion block. Price retraces back and touches the low of this candle. Also touches the opening of the order block, and we are down. Oh, how about here? This is H1, but it can literally be used. I mean, I've already shown you examples in the lower time frame. So what is this? Learn on stops, 100% confirmation. 100% confirmation. Where is the next draw? It's here. Why is this not a reversal? Because price has been bearish. So don't tell me this is a reversal. This is a continuation. From here, price is bearish. You see that? So this is not a reversal, rather a continuation. Price comes back to the candlestick that is responsible for the global liquidity. The second candle went above the order block, broke it with massive volume. Price came back into the order block, sell to the next pool of liquidity. I wish you well, guys. Thank you so much for your support. Share, watch and subscribe and share, and on Twitter, retweet, guys. What's wrong with you guys? But anyways, until next time, stay safe.